Hey everyone, it's Helen from S&B Deal Hunter. Today we have Michael Bourgeois with us. Michael is co-founder of Skyline Partnership, a holding company where he and his partners have made two acquisitions to date. Michael is also an Air Force veteran, and he's also worked as a private equity analyst in the past. So I'm really looking forward to hearing Michael's story. Michael, it's great to have you on today.
Thanks, Helen. It's really excited to be here and catch up with you.
Also, I should mention Michael's one of our latest M&A advisors in the S&B Deal Hunter Pro program. I can't believe I forgot to mention that. So it's been great having Michael on the team. But Michael, let's start with your background first. How did you get into this world of, becoming an independent sponsor, getting into acquisitions? What were you doing before?
Yeah, that's a good question. So the to kind of start from the beginning, I'm an Air Force veteran. I worked at Travis Air Force Base at the AMW. David Grant doing running medical practices. I always liked working with people. Wanted to be a doctor at one point, but decided it wasn't for me. So got out and this private equity group took a chance on me and really just worked my way up from there. And I've always been a big value investing nerd, but more so, I've always liked wanting to do something more tangible and work with people and work with processes. Like anything that you can read in a book, like there's so much you can read and information you can get from reading a book, but from what actually running a business day to day, it's completely different. Like no book or core, no book or no studying can prepare you for that, right? So my business partner and I met about 4 years ago at a private equity networking event. His background was in public equities. We became very close friends, had that business prenup going, and decided to partner together.
And how did you decide to, like, what caused you to actually leave your last job? What was that trigger?
It's a good question. So there was some personal things behind that, but really the biggest thing was like I could do financial modeling, I can do business analysis, but I just wanted to work with people again. Um, I would say just wanting to also build something more tangible for my family too, as well.
I know a lot of folks, work in private equity and they, dream about maybe becoming an operator one day or doing their own thing one day. Were you doing this whole search part time in the beginning, or did you, fully cut ties from your last role and then, officially kind of partner up?
So that's a good question. So there was about the first 6 months to a year we were doing it kind of part time. And then in 24, we decided, hey, let's just one of us just do it full time while the other one works. And that's the way we ran our search. So I left my last role and then started doing it full time.
Got it. And what was your guys' kind of thesis going into this? I'm sure you guys spoke a lot about this, both, coming from an investing background. So love to learn more about that.
So it's changed in my experience. What you look for, or what you think you're going to find, is not what you actually find. So, if you'd asked me if I ever would own an HVAC, the stereotypical HVAC plumbing electrical company, as a lot of ex-military vet searchers find, I'd say you're crazy. So our original was really construction. My business partner has a structural engineering background. We looked at a few different industries, just really around uh, prefab, concrete. We've looked in a few different industries, architecture, but we really transitioned and pivoted more towards technology. And then we obviously buy an HVAC company because that's the next logical step, right? So uh, our main focus is still technology, but we're opportunistic in that sense. And so it's just really, I would say that I don't want to say we're industry agnostic. We are opportunistic to a point, but we do kind of have a narrow buy box. It's really the characteristics is ideally recurring revenue to some degree and non-discretionary. That's really our only two main criteria. That's our two criteria.
Is there any sort of deal size that you guys, have are looking at from like a minimum, maybe EBITDA perspective or anything like that?
So our absolute floor EBITDA is 3 million. We primarily look at between 5 and 15 million in EBITDA.
And have you guys, going into this, was your idea that one of you guys would kind of become almost like an operating partner or be an operator in the business, or um, how did you guys kind of think about that?
Great question. So in this for this specific acquisition, my business partner is Ashish, so he's the full-time operator, and then we also have a GM in place, and it would be one of us operating in the business full-time for at least the first few months, and then we won't really. I mean, it's really about you know, you never want to sacrifice um, good for than pursuit of perfect. So in our mind is if we have a business that's like 75, 80% of the way there to where maybe they have some systems in place, maybe they need a little work, but we can get an operator in place in like 6 months. That's a good proposition for us. So the first few months we're hands on, and then we tend to step away. That's also part of the reason why we're looking at such large businesses as well. They more likely than not at 3 million plus in EBITDA, you're going to find something that's already almost set up to be able to run itself.
I'm curious, with your first deal, how you came across it. Where were you kind of looking at opportunities? Obviously, it's not easy to come across a deal that's, with at least 3 million in EBITDA. So, where have you guys been, identifying these opportunities, and how long did it actually take you from, starting your search to closing that first business?
Great question. So we 90% of our sourcing is off market. We do a lot of our just in our network from networking at different conferences, business owners, and just really building those relationships over a long term. My suggestion is if you talk to a seller that's not interested in selling, I always like putting them in the CRM and then annoying them until they're ready to sell, or they just tell me to not contact them anymore. That's kind of but for the first one, we found it through a colleague, a professional colleague in California, that had a background in the cybersecurity space, and we connected through him, got introduced to a few people, and then one of them was interested in partially exiting, and so we're working. So he's still in place. We're working together, and we're conducting kind of a roll up thesis on that one. Um, HVAC company that we bought, same thing pretty much. Private equity, networking, personal relationships, and so that's one of our main methods is just professional network. The other thing is I always like to, if we're looking in a specific geography, is just sending out a lot of personal letters, mailers to business owners. Anything that can kind of cut through the gatekeeper in a way is really helpful. Um, but yeah, it's funny actually. Now that I think about it, we're off market, but we kind of bought both of these businesses in the same way, and I hadn't actually thought about that before.
No, that's super interesting. And are they both sort of, is there a role at play with both of these, or how do you guys think about the businesses you do acquire? Does there have to be roll up potential for you guys to go after them?
No, I would say as far as you can kind of, I'm really again big into value investing, and so there's a few um, good books I could probably suggest, but I don't think every business really necessarily needs to get grow or get larger. A lot of times when a business that isn't designed to grow does, it could damage it in the long term. In our mind, if we find a business that runs fine, it's great as is, and we can use that business as an economic engine to invest into other businesses, that's great for us. For this, the Cardinal acquisition, we are focused more on organic growth first. So we're building out the plumbing and electrical division at Cardinal. We have the business does. I can't give too much guidance to deal structure because of the the NDA that we signed with our the group we bought from, but it does top line about 13 to 15 in a year in revenue, and then the rest of the divisions have the potential to do that much themselves, and so that's really we're going to be focused over the next 5 to 10 years of really just making it a full home services company. Will we potentially add in maybe a small plumbing and electrical company to kind of accelerate that growth? Probably. Um, I would say, in my experience, that acquiring something 30-40% of your size, it's a lot easier to integrate. So that's something that we're exploring. So for the other one, the software developer, yes, absolutely, it's a role play. That company, what they do is they provide a service that one of their services. The reason why we like them is it helps to um, the software to reduces false positives in threat detection for like MSSPs. So we're really focused on an MSP cybersecurity rollup.
Got it. And when did you acquire that first business, the software development one?
So we acquired that in mid 2024.
How's that been going, by the way?
It's fine. I mean, to be honest with you, I'm not really involved in the day to day. It's kind of nice. I'm kind of just managing KPIs and so it's really still the original founder's baby, and so he's just running it. So
And
it's
how
not.
did you how did you guys, if or whatever you feel comfortable sharing, how did you structure the deal to keep the original sort of owners in, and what was the kind of thinking behind that?
So the one thing is so when you're going above the SBA limit, when you're doing a more traditional private equity deal, you don't have as many guardrails, so you can structure things. You can do like payment in kind, which is like a concept. I don't think you can do that with you can't do that with the SBA. You can do
Tell,
earn
tell
out.
us tell us more about that.
Sure, a payment in kind.
Yeah.
So payment in kind essentially it just so say if I take out um $1 million and I have it tied to like a pick, it just accrues interest until it pays off. So you don't have any payments up front. And so it helps you with cash flow in the short term, but in the long term, if you don't manage it well and start paying it back, it can really compound. It's essentially compounding debt, which it's really can be kind of dangerous. And so that's part of the reasons why the SBA doesn't really allow for it. Um, Earnouts, you can do a forgivable seller's note that's tied to some sort of metric, but you can't do earnouts. Um, but in non-SBA deals, you can, so you have a little bit more guardrails and you can also retain more equity as well. And so, he still has a good chunk of equity left in the business. And the proposition there is like, hey, if we grow this thing and we grow it by X amount and we do these acquisitions, your 40% or 30% will be worth exiting the business, twice or three times over. So that's really how you sell it to those to the people that are wanting to exit, but it also depends on what they're really looking for. So the owner of that business, he's in his mid 40s. So he's really looking to grow, and he's looking to build something with his family, and he's talking about how he wants his son to work in the business. So it's really just finding the right person to partner with.
And do you view that as sort of like a long-term hold? Do you guys have a holding period in mind? How are you guys thinking about that?
So we're not really private equity, we're more permanent equity. So our time horizon's minimum 10 years.
Got it. How did you kind of, I guess come to that conclusion or decide on that?
So my finance background, again, I think I've said this probably three times. I'm a big value investor. I'm a big fan of Charlie Munger, Warren Buffett, and so there's a lot of studies, math that does this. I think that doing a really short term time horizon, there's going to be years. So, for example, Warren Buffett, he returned an average of 18% over 70 years, which is insane. But he didn't return an average of 18% year over year. He had a period where he lagged the S&P, where he probably even lost money some years. But then overall, over the long term, that compounding of capital is what made him the best investor. So in our mindset is okay, if we're holding 3 to 5 years, then that's not really enough time to really reap the benefits of actually reinvesting that cash flow back into the business. So for the first year, we have a mandate where Ashish and I we don't take a salary from the business at all. Any of our businesses, which it really does. So every dollar that we don't take a salary goes back into the business, and in 10 years that could be $10. But in the short term, we feel a little bit of pain, but in the long term, we are able to really accelerate that growth in finance. It's called ROIC, that returns on invested capital. And over a 10-year period, I'd say at the minimum, you can really realize that 30, 25, 30% IRR. That's just our opinion. There are firms that are really good at short-term holding periods. It's just not us. We're too simple.
I'm curious, going into this, obviously a lot of folks are buying businesses, buy smaller, they go SBA versus,
Yeah.
you're buying, bigger business, not funding it through the SBA. How did you sort of, I don't even know if that was a consideration, but how do you think about that? Obviously, you understand the SBA ecosystem as well.
Mhm. Good question. So it's an interesting question. So when you're going through larger deals, you have a few different, I'll say in kind of the order of least expensive to most expensive debt. You could go through a traditional bank. Usually they'll do floors of 15 million, or they'll loan you say 15, 20 million on a deal. You'll have to put down more money. LTV is going to be different than the SBA. So a lot of these more traditional debts, they're not going to be as highly levered as the SBA. Not even close. So in a lot of deals we're looking at, there was a company that we were under LOI with. It fell out, unfortunately. It was a cyber defense contractor that we had, I think, 48 or 49% debt on it. So so when you're getting into more the traditional debt, the the amount that you can pay goes up, but also the amount of debt you can get on a business goes down significantly. But anyway, so the least expensive debt is really traditional. Then you have an SBIC, which is a small business investment company. Think of it as it's essentially government backed debt mixed with private capital. They're really good options for like the 10 to 30, $40 million range. They can go up to 50 million. Um, but usually you'll have multiple SBICs working together. And the way that they work is they'll give you the debt and then they'll invest a minority stake into the business. So they usually won't be the they won't be the majority investors. So it's really good because they're debt and equity. They're a little bit more expensive than traditional banks, but they're not the most expensive. The most expensive is private credit. Private credit is kind of, I'm still learning about it myself, but um, you have to pay upfront for origination fees. They're expensive, but they're a very high chance of getting some sort of deal structure funded. But you're paying 15 plus percent interest on your money, and so it can get really expensive really really quick. So like in that option, the private credit deal we were looking at, it was a 15%, this cyber defense company, and then the actual debt amount was similar to the SBICs we're looking at. The SBIC's DSCR was like 1.5. The private credit went down to like 1.1,
Wow.
1.05. So it can be expensive. I would personally avoid private credit, and I have a lot of reasons why, but it would take longer than I think this interview. Um, but in short, essentially, the amount of debt you can get is going to be significantly less. You're going to have to come up with probably more investors, a higher down payment. And then also there's a little bit more of a floor compared to the SBA. So I mean, usually it's really hard to find financing on a deal under 15 million.
And how did you think about sort of going for these larger deals and going down that path versus, SBA? I think a lot of folks kind of look at those two paths, or maybe if they come from a more private equity background, think about going larger. How did you think about that?
So my thought process is there's a lot of benefits I think to starting really small. Um, I would say that just given my experience in the military, I'm good as a multi-unit manager. And rather than more of a doing like a zero to one, just starting things from scratch, it's just really what my personality and what my skill set is. So I think part of it for me is circle of competence. Two, we are looking for something to where we could have some level of a cushion because, even in even 15, $20 million deals in, for if we're talking public markets, that's a micro cap stock, right? So like these companies can go up to several $1 billion, and before they even get a lot of good systems in place. So for example, I was talking to somebody today, and he was talking about how this company he was speaking about IPOing with this founder, and he doesn't have a CFO, and this market cap's $2 billion. So like that's just my thought process. Is I truly am looking for something that I would say is more scalable. Um, and eventually, I want to get it to the point to where my family is involved in 20 years, where my kids are involved, and um, I'm really thinking about, I think, more of a long term, just larger overall, like constellation software type play. That's a little more of, I think, a roundabout answer to what you're asking, but yeah, that's just how I think about it personally. But everybody's
I think
different. Everybody's
Yeah, I think people often forget that even, a 15 million, 15, $20 million company is still very much a small business in terms of often how it's operated.
so if you go to McGuire Woods, it's really, it's kind of a fever dream when you have the conversation. So I went this year, and you're just casually going up to these guys, and you're like, "Oh yeah, I'm Mike Bourgeois, Skyline Partnership," and they say their name, and they're like, "Yeah, we manage $40 billion," just so casually. Like it's such a, it's a lot of money, but in the realm of deals, it's not. It's,
Tell us about No, I think that's great insight. Tell us about how you're actually financing these deals, right? Because you don't have the SBA, and it's not just, most people going with an SBA deal, they're putting usually their own down payment, maybe they're getting some friends and family, some occasionally they're bringing on some investors. For you, are you guys putting in your own capital? Are you bringing investors into each deal? Tell us about that.
so for these first two deals, so we label ourselves as an independent sponsor, but for these first two deals, we didn't bring any outside capital in. So for the HVAC company, I can't, just because of the I can't give a full guidance to the exact structure, but what I will say that it was a very heavy cash deal, and for the software developer, that was more of a traditional financing structure. So we use a mix of just primarily SBIC debt, and then equity, and then I think on this, when we get to deal three and above, we'll definitely need to start bringing in investor capital.
I'm curious, in your space, how you're um, finding investors, now that you're thinking about deal three, and also how many deals are you, trying to target doing? Is it just, whatever sort of happens? You guys have a goal in mind as you guys are building this holding company. I'm curious to hear more about that.
So the thing about goals, and it's actually, I'm stealing this from Patrick. Oh, he was the Invest Like the Best.
Oh, Shaughnessy.
Shaughnessy, yeah. Um, he spoke about how it's good not to have goals because you tend to reach them. And then so I don't want to set my goals too low. So my mind, I'm kind of, hey, whatever happens, happens. My personal thing I would like to, going forward, since we have the bandwidth, is to buy one deal a year, company a year, for, if we do 10 years, 5 years, that's fine. I haven't actually thought about that really that much, to be honest with you. But if in 20 years we have 100 companies, that would be great too. But if we have two, that's also fine.
How many deals do you have to look at a year, do you think, to actually get one closed? Or what's been sort of the funnel in the past, or the first two deals? How many deals are you looking at?
I'm going to sound a little bit like a hypocrite saying this because, to be honest with you, we didn't really aggressively source. It was purely through our own network. But um, when we have the infrastructure to source more, I would say to close one deal a year, we probably would have to go through about, at the scale we're doing, probably about 3 to 5 thousand companies.
And when you say 3 to 5 thousand, tell us what that means. Is it 3 to 5 thousand that you're reaching out to, that you're having
Uh,
conversation? Like, what does that actually mean?
I would say reaching out to 3 to 5 thousand and having conversations with probably about at least 1,500 to 1,000. So we are starting to looking at bringing on interns, because that would be, I can't do that myself, or outsourcing that, and then having, probably at least a few hundred to 100 really in-depth conversations, and then maybe, two to three LOIs will come out of that. I mean, the biggest thing is when you're as being successful as a searcher, and again, I sound like a hypocrite saying this because we just didn't have the engine turned on, was that it's really how full your schedule looks day to day. If you're getting really consistent meetings with sellers and you're doing everything right, and you have your sourcing engine on, um, you'll find something, you'll be successful. But it's it is a lot of work, especially upfront.
Yeah, no, totally agree. I'm curious, how what your day to day looks like as you're. I know you're thinking of bringing on interns, but what does your day to day look like? And what does your diligence process look like since it's just, you and your partner? Um, how do you guys run that?
That's a great question. So my my process is, so we have a short list of lawyers in QOV that we speak with, that we have we I mean, I've done this a few times, my previous experience. So we have a pretty good matrix of, this is the ABC thing we have to do by X week. We don't always share that with the seller depending on their personality, but it is really important. I mean, even if you're doing a broker process of staying on top of everything and just over communicating, I would say. So we also do really utilize VAs a lot, to be honest with you. So it's just because a lot of look, think about it. Helen, if you're making, you know, $1 million a year, and if you break that down hourly, why would it make sense for you to be setting up all the phone calls? That means you're essentially wasting, $1,000 an hour on doing something that you
Yep.
could pay somebody, you know, depending on where they're from, that's significantly less than that, of course. So we really just utilize delegation and VAs. So it's really just staying on top of that. We do have a hand in the financial modeling and making sure that that's actually set up, and also the QOV, the diligent process. But it's really like, hey, you're the QOV expert. We're not going to bother you. We're going to get the documents to you as quickly as we can and over communicate. But you're the expert there, the legal expert. We really lean on them. I mean, we're not lawyers. Um, where we really ask the questions are, okay, what are the industry drivers? What's the, how what does the value chain look like? What's the owner's day to day look like? What are the growth prospects? What's the competition in the area? What's the cash conversion cycle? Like, what are the working capital needs? Just items like that. What are the red flags in the business? What does the business do well? What could it do better?
How do you guys think about, when to start a QB? Because obviously you take a lot of searchers, especially, in your seat where you're not bringing on outside investors, you're worried about dead deal costs and incurring a lot of that. So how do you think about what diligence you do before you bring on, third party lawyers, QB, et cetera?
That's a good question. So we do QV pretty early on in the process because, frankly, it's generally speaking less pricey than going. I mean, usually than lawyers. So our thought is, okay, we'll do a QV ASAP, and we'll then bring in the legal diligence and legal process, and pretty much follow on everything else after that. And so you can kind of have the QOV in two buckets. You can kind of do an initial light QOV where they take a high level look at the numbers and that looks good, and then you can go deeper into the process. Um, it's also, in my opinion, too, especially if you start conversations with investors after the LOI, um, to have the Q of V at least close to being done, because they'll want to take a look at that as soon as possible. I do think it is a balance, though, and being able to filter of, okay, I have all the documents. Let's do an initial filter. If there's anything that's glaringly a red flag or I need to talk about, um, handle that first and either do the QV or pass from there. So it's a balance. So I would say probably within the first 1 to 2 weeks, that's when we're starting the QV.
No, that makes sense, especially when so many QBs turn out to not be what you expect the business's financials to look like. So a lot of
Yep.
people end up wasting a lot of time.
Yep.
Um, I'm curious what it looks like for you guys when you guys transition a business, because you're obviously um, looking at a certain deal size where, hopefully after a few months, you're not in the day to day as much. And maybe there's already a team in place. So, what does your guys' transition process look like? I know you're in the process of one right now, as we see, but tell us more about that.
I would say so. This one was interesting because it was, so in the other one there was definitely more of a process. I mean, the seller stayed on. In this one, It was literally the old GM showed up and gave us a tour, gave us the keys, and said, "Good luck." Usually, just because it was a from being sold from a private equity firm, not from a seller, so it was a little bit of more of a cut and dry, quick process. But that's even abnormal. Usually, you have at least a few months of transition. It would be you'd be taking on a little bit more. I mean, the first few weeks you're just observing. We unfortunately for this one we've had to be hands on from day one, but um, in a normal transition, it's hey, here, let's document everything that's done in the business. Let's really start to ask questions. Let's figure it out. I'm here to listen and learn. I'm not really going to change anything immediately. And then as you pretty much transition the task from the seller over to you, you take on more and more over time, and you're really just there to learn, and then learn by doing as well. In this process, unfortunately, was hey, here are the keys. Good luck. Nothing makes sense. Figure it out. So it is a little bit of an abnormal transition, I will say in this case, but it's fine. The first 2 weeks is the first time in my life I've actually lost hair, so that was fun. But
Wow.
um, but it's a lot more stable now.
No, that's great to hear. And what kind of, as after you start documenting things, at what point do you guys start actually implementing changes? Or tell us little bit about that for the first acquisition. Um, what did that look like? Since that was more, I guess there's not no such thing as, no, a normal transition really, but a little bit
Sure,
different.
and I'm happy to talk about both definitely. Um, so it's really like, hey, there's a mindset of in a lot of these companies, okay, it's always been done this way, or we haven't done price increases in X years. And then just going of being understanding, okay, you're not going to know as much as the seller probably ever, but to have a healthy kind of outside perspective and to really analyze what are the low what's the if is there any low hanging fruit. To so in the other business it was operated more cleanly, frankly, than this one. So we found uh, roughly, I think we're at 1.17 million in cuts we've already made in this
Wow.
in this business, and
And
just
how long has it been?
2 weeks.
Crazy.
So and for this business, it was literally, hey, nobody's managing the subscriptions. We have three different subscriptions for the same thing. Let's cancel two of them. We only need one of them. We cut $100,000 in costs for the phones, and it's not even. I mean, we're not done yet. I actually have the idea of actually just asking for an itemized list for all of our subscriptions to just go through it. But just, I guess my point is that you might see things that are very obvious from the outside, and then don't be afraid to try things. I mean, the big thing is getting a good operating system in place. So we use the EOS system at this business, and just realizing, like, asking questions, making sure the employees have the ability to give their input and actually ask for, give feedback is really important. Um, I would say week one is if like you're looking at changes, like the first things you can usually make around pricing. Um, it's important to get a pricing elasticity. I mean, that's kind of a longer term thing because you need data, but don't be afraid to just try and raise prices by 3 to 5%. Usually, in most cases, people will be fine with it, especially if it's like a non discretionary need. In our business, in some cases, in some divisions in this business, because we have multiple, we haven't had a price increase in 5 years. So just really low hanging fruit. Hey, increase prices. Um, and the software developer, it's okay. Pricing model is a monthly subscription. If we really want to grow, though, what we decided to look at is okay, let's do an annual. Let's give 20, 30% off. We can do an annual subscription or a 2 year subscription, get all of that money up front. Yeah, you have some unearned revenue, but in theory, I mean, as long as you can manage your returns, you can actually use that growth to that money to reinvest into the business. So just little things like that around the pricing model, marketing, daily ops, just things that make sense. So in that business, the software developer, it's just, hey, how do we get everything off the CEO because he was really handling everything. He's still in the business full time, but He has to be focusing more on growing the business than anything else, right? So in this business, it's okay, what are the SOPs around, in the morning, our medium term goal is to make sure all of the vans can be dispatched directly from the tech's house. And so we don't have to, send them here in the morning because it wastes on fuel costs. But in the short term, we started staging all the vehicles the night before, right? So just little changes like that, 1 to 2%. I'm a big believer in Kaizen, so little 1 to 2% changes that will add up over time.
And how have the employees, I guess, for both businesses, reacted to new ownership changes in general? Obviously, you guys are implementing EOS, probably in a business that didn't have an operating system. So how's everyone sort of um, handling or dealing with all the changes?
And so with the software developer, it was, I would say, pretty neutral. I don't think they were surprised, but they also weren't upset. It was like, hey, really day to day, not really much is going to change because it's still going to be the same leadership. So it's was very pretty seamless. With this one, it's been, we have made, I think, 1 or 2 mistakes along the way so far, but it's been overwhelmingly positive. Like they're very excited. So I think that they're very relieved that there's new ownership in this case, and so they're definitely excited to be working with us.
That's great. And how have you made them sort of, I think with a lot of new acquisitions, the employees, are worried about maybe job security or things like
Yep.
that. Did you guys sort of deal with that at all?
We did. It was a lot of, we have a open door policy. It was a lot of just conversations, just talking about where we're going, getting everybody rowing in the same direction, um, just discussing the state of the company and just being really transparent about it and what we need to do, where we are and what we need to do and not, the since especially it was cut off so quickly that whatever that they were doing previously, the private equity firm that we bought from doesn't really matter anymore because it's all us working together now. Um, and I think actually doing that and then listening to potential feedback from the employees helps a lot, but little things too. So, we one of the biggest things that we identified with this business is training. And so we have weekly trainings, but we also have a monthly training where we take half the day off and we're just doing trainings in the morning. But in the morning before we start, we do a monthly breakfast to just talk and discuss and like little things like that to actually help with morale helps a lot. Uh,
That's great. That's great. And I know for this one, you're hoping to some point sort of find an operator or a GM or I guess a CEO. How do you go about sort of identifying leadership and hiring?
that's I think something we're still trying to figure out. So we actually do have a GM in place now. We didn't have one until about a week ago. So it
And
was
how did you find that GM?
we used kind of the resources we have at the time. So he actually was an internal employee in the company. It was just identifying, okay, in his case, who has good leadership potential. Um, you need a good mix. I mean, you don't want to hire somebody who's brash in the GM position or jerk, but you need somebody who can be assertive and actually direct and guide people, but also has the respect of them. So he had the respect of all the employees, very highly competent, very highly organized, and so we believe in in the medium term that he'll be a really good pick for the GM. I don't know if he'll be a long term pick for the CEO. I don't know if we have somebody identified in the company yet. I would say in this case, when you can, it's really important to kind of hire slowly and to be able to really and as Charlie Munger says, so we don't train people. You in that case, in an actual CEO position, we would rather have somebody who's already done it or already has the experience doing it. In every other position, we think people are highly coachable and we'll coach them. But for that, with that type of oversight, it's not something that we train for.
That makes sense. And when you took over the business and the old GM basically left, I'm
Mhm.
guessing with the previous business, what did that look like? I mean, was
Just a handoff. Just a handoff. Here's the keys. So he was working with the other group, and so he's still with the other group, and he's like, "Here's the keys. Good luck." So it was pretty informal.
and was the business, running, I don't want to say as usual, but performing as usual without with the GM just out the door so quickly? Or was there a quick scramble? What did that look like?
No, so the GM has been pretty honestly pretty hands off. So it I would say the unusual for the business as the usual. So he's been pretty hands off the past year because the group was focusing on their other portfolio companies. So yeah, I mean, if anything, us coming in and being more active, just doing that has gone a long way.
No, that's super interesting. I'm curious, as you've been sort of in this space for a little bit now, and even before this, I guess, in private equity in the lower middle market, any sort of trends you're seeing emerge, the past year or two?
That's a good question. Uh, I would say so in HVAC specifically, it's the market's softening a little bit, definitely. I'd say it's cooling a little bit. It's not a great time for HVAC companies, which is ironic because I own an HVAC business.
What do you
Um,
attribute that to?
I don't know if it's just the weather. I mean, I think frankly, as far as multiples and acquisitions, it was a hot market for so long that I think we're going to see a lot of these groups. Frankly, their businesses not perform well because when you're leveraging 20 times debt on a business, it's when you have 20x, you're paying on 20x multiple. It's really hard to do well
Yeah.
from a return standpoint. Um, I think there's a lot of uncertainty initially around with tariffs, and that definitely impacted a lot of businesses. I don't know how that the long term impact will be with that. Um, so in the technology space and cybersecurity, you're really having to look at, I would say, higher value added services because a lot of these cybersecurity firms, the multiples or the margins are compressing a little bit as far because they're becoming more commoditized, especially around AI. So when we're looking at technology specifically, we're looking at really highly technical jobs that just AI can't do yet.
Mhm.
But the overall market, I don't know because I follow it, but I haven't really my time horizon's so long term that I don't really think about it day to day, to be honest with you, or that often.
No, what do you kind of mentioned AI for the software development business, but where do you see that sort of impacting the space in general?
I think that it's going to make more personal, higher touch services where there's actually people in the long term. It will make that more valuable. Um, I think that there'll be a lot of there actually will be more information and efficiency because if everybody's seeing the same thing, the people that actually take the time to analyze independently of AI will get more information. But as far as the impact, I think low level jobs, entry level jobs will pretty much be all done through AI. I think it will be the mid to senior jobs that will still be done with people, and I think will augment work. I don't think AI will necessarily replace completely. And you have the argument. I know that some AI can do some procedural work, and it's becoming more complex. But I don't know if that section will ever be completely be replaced by AI.
Are you guys already seeing any efficiencies across, I guess, your two companies with sort of AI becoming more prevalent, or not quite yet?
So we do use AI in both companies. So part of the service that we provide with the software developer actually is AI. So it's kind of an AI for AI, ironically. But the phone service we use in the HVAC company is after hours. It's an automated AI dialer. It is fine. It isn't that great, but it's good for emergency calls. But we're still evaluating. I would say we're really looking forward to utilizing it for pricing and inventory management, but we haven't had a lot of chance to really implement it yet for the HVAC company. But the software developer is AI.
Got it. No, that's interesting. I'm curious, any specific, you kind of talked about HVAC and is obviously very, very, very loved by private equity. Any sort of industries that you're very bullish on right now, and any ones that you think may be overrated that a lot of people are looking at?
I would say that you're going to find the most success out of a colder industry because the multiples will be less, generally speaking. I don't know if the multiples are necessarily low, but I really liked my initial thesis was around water quality testing, just around the regulation, especially building a um, if you're building a property or if you're building a commercial building. Usually you have to get a water quality testing certificate before you can start. And then also geographically speaking, you it's very geographically constrained because you can only transport the samples so far. I thought that was pretty interesting. Um, Prefab concrete, I also find interesting too. So concrete itself is a pretty cold market, but prefabricated concrete, it's concrete that's made in a factory. It's molded and made in the factory, and so it's cheaper than set in place concrete, and then also it's a lot more efficient. So it can be also cheap. It can be not necessarily. I would say that where it can be actually worse for you is if you cast in place, if you have to resend it back, it can be kind of a pain. But that's interesting. I know building materials and building supplies becoming more popular. I'd say chemicals too, like chemical producers, just anything that's non-discretionary that people don't look at necessarily a lot. Looking at fire, what is it? The actual there's fire components or fire safety components manufacturing. It's pretty interesting too. But I'm really niche. I suppose I really focused on really niche industries. I guess.
Yeah, no, that's I love those. I love those examples. I'm curious, what now that you've kind of been in this space a little bit, anything you would have done differently with your first two acquisitions, for someone maybe new coming in.
So I would say in this HVAC acquisition is definitely plan better for the transition. Just plan better in general. For the software developer, no, I don't know if there would be too much I'd do differently. I would say that for both, we did a good job for with the information we had going into it. I would say just turning on the sourcing engine more. Don't be afraid to push back against like a broker or a seller because you have a lot more negotiating power than I think that you think. So one that we bought that was completely kind of out of left field is we were buying a specialty construction company. What they did was is they did really short term, really high margin projects for like airports, and we negotiated 95% or 90% seller financing, but we probably could have gotten 100% seller financing, which is very rare. And the only reason why we were able to do it was just because of the licensing requirements and also how tied to the business it was. The owner was going to stay on for a few years, but those don't happen often. Maybe one out of every 1,000 deals you look at, you can find something like that, and there's usually a reason why they're 100% seller financed, right?
Yeah.
Um, I would say be more aggressive. I would say that to be more aggressive and then push back more. Definitely, I'd say that this might be controversial, but I think that most people are maybe too nice to brokers or too nice in the sense of I don't know if nice is the right word, but too agreeable with brokers. So I'd say being just pushing back a lot harder on valuations and things like that, and just actually being able to negotiate. Um, but what I'd do differently is probably organization.
From like a sourcing perspective
I would
or
say from the transition
transition.
perspective, yeah.
I'm curious, you're getting into these industries that you may not have had, direct experience in, but what's your perspective as, for a searcher as to, how much direct industry experience they have to have before getting into a specific business?
I think the answer kind of depends on how complicated it is, will want how big it is and how complicated it is. If it's landscaping, that's much easier than engineering. So I would say just it really depends on the business and industry and what you do specifically. So if you're an accounting, if you're a bookkeeper, I bet you're looking at buying a parts manufacturing company. I mean, that's probably going to be an easier lift than somebody that has a background in landscaping trying to buy a really high-end specialty engineering company. So, but to answer your question, I would say that if you buy big enough, frankly, you do have to get an understanding. You can probably learn 80% of what you need to know theoretically in 5 to 6 months, but it's going to be kind of tough to get that last 10%. That last 10-20% is going to take years. But I think like that also comes back to actually asking questions, getting input from the staff. And if you make it very clear, like, hey, my role is finance, operations, and strategic oversight. You guys are doing more of the day-to-day technical work. I think just that honesty will go a long way. Um, but also just having kind of that realistic out like that realistic perspective. Okay, do I have at least an understanding of what this industry does? I think if the answer is I can understand this industry, then more likely than not, then that's fine to go forward. I but I'd have to think about that more.
Oh, I think that's great. No, I think that's a great perspective. I want to be sensitive of time, Michael, but I guess final question from me. I don't know if you've had much time to kind of look back, but is buying a business everything you expected it to be?
Uh I feel like most people would say no, but on my situation, yes. Like I kind of knew going into it that it would be difficult. Like operating a business, I would say buying a business is definitely different than operating it. I would say operating it, like I knew going into when I actually started operating something, it would be, it's worth it. It's fulfilling 100%, but it's definitely, it's not, I don't want to give like a rosy picture that it's easy. It's not. It's not easy to just go in and operate a business, but it is worth it. And it is about what I expected.
When
Yeah.
you say buying and operating as business, a business is different. You're referring to, previously when you were working private equity and you guys were buying, but
Mhm.
you weren't actually independently going in and operating the business.
No, 100%. I mean, I haven't had this much operations since I was in the military. So, yeah. Yeah, I haven't. I guess it's been, years.
No, that's great. Any sort of final words of wisdom, especially I guess for the first time buyers out there, maybe.
I would say for how much you get out of it is really a product of how much you put into it. Now, that doesn't mean like just by working smarter or not working harder, you're going to get more out of it. But I mean, is by working harder, but also with um, kind of like understanding the best use of your time and how to be as efficient as possible. Like, don't just try and do everything yourself. Get if you can outsource to get VAs, do it, um, and then just get those systems in place. It will take work to get those systems in place, but when you can, you'll do a lot better than I think you could just do it alone.
No, that's great advice. And Michael, if people want to reach out after listening to this, what's the best way to find you?
I'm on LinkedIn. My name on LinkedIn, I believe, is just Mike Bourgeois, Bourgeois, or Michael at skylinepartnership.com.
Great. Well, Michael, thank you so much for joining me today. Um, right after the Christmas New Year holidays, so I really really appreciate it. And I'll let you get back to things, but this is awesome. Thank you again, and excited to keep following along the journey with both acquisitions and hopefully more to come.
Hey, thank you so much for having me, Helen. I really appreciate it.